Yo, what's the deal, y'all? Happy Monday, man. It's a new week. It's a new month. It's February 2021, man. So a lot of people found my page because they're interested in trading stocks, making money, investing their money, and I noticed there's a lot of confusion on my page and my comments between the difference between stocks and options, right? So some people trade stocks, some people trade options, some people do both, and I'm just here to break it down, right? So I know a lot of people found me because there was some bags ran up last week in the stock market. Now, you're curious, you want to run up your bag too. But before you run up your bag, before you can run up your bag, you need to understand the lingo. You need to understand the risk. You need to understand what's going on, right? So I'm going to break it down for you. I'm going to do a little video, explain the difference between stocks and options. And stock is a certificate of ownership, right? So if Chris has a pizza, Chris's Pizza has 100 shares outstanding, and Kim owns 10 shares of Chris's Pizza. She owns 10% of the company, right? So these companies issue stock so they can raise money, so they can go, expand their business, right? So how do stocks make money? The value of the stock goes up and you sell it to somebody else. So for example, like we're going to use Tesla. So the lowest price for today in Tesla for one share was $797. And so far, the highest has been $834. So imagine if you buy at the lowest point, you sell at the highest point, you made $37 in profit. So if you had 10 of these, you make, $370. If you had 100 of them, you make $3,700. If you had 1,000 of them, then, you make $37,000. So this could be played with any amount of money. So me and somebody that got $100 billion could buy the same shares at the same price, and we could have the same profit per share, except he got a lot more shares than I do, right? But that's basically what happens. The stock is just, ownership. It's ownership into a company. Now, an option, on the other hand, an option gives you the right to buy or sell a stock, right? So it's a contract that you're buying. So options have calls and put. So a call means you think it's going to go up, the price of this stock is going to go up, and a put means you think the price of the stock is going to go down. So for instance, we're going to use Denny's. So their symbol is DNN, right? So this is the symbol, this is the strike price. So I'm thinking Denny's is going to go up to $20. The expiration date, these contracts expire. So you have an expiration date. I think Denny's is going to go up to $20 by 19 February 2021. Here's the symbol, Denny's, strike price, $20. So let's say the current price of the stock is $15, and I'm guessing I'm going to make a call. I'm going to buy a call to make an educated guess. It's going to go up towards $20 before 19 February, so 18 days from now, right? So it's a call. So if you see a C, that means call, right? Now, here's one thing that people need to understand. It does not need to hit $20 for you to make money. It just needs to move towards $20 to make the value of this contract go up. And I'm going to talk about why the value is going to go up, right? So for instance, the price of this contract is 15 cents, but this contract is giving you the right to buy 100 shares. So 15 cents times 100 equals $15. You're going to pay $15 for this contract. But when you see it, on your brokerage app, it's going to say 15 cents. Multiply that by 100. That's how much you're coming out of pocket. It's $15 for this contract. So how do options make money? The value of the contract goes up. Why do the value of the contract go up? Because the value of the stock price moves, right? So when the stock price moves up, if you have a call, the value of the contract goes up. If you have a put and the value of the stock goes down, then the value of the options go up. So you can make money if the underlying stock moves in the direction that you need it to move in. For a call, you need it to move up. For a put, you need it to move down, right? So for example, you buy this contract for Denny's for 15 cents and you sell it for 30 cents. So you buy for one contract costs you $15, you sell it for $30. That's 100% return, right? So you just doubled your money, and this could happen instantly. You don't need it to hit that strike price, and you don't need to wait till 19 February to sell, right? So you can buy a contract and you can sell it right away, right? But this is when the contract expires. All right, so let's do a little recap. When you buy stocks, you're buying a certificate of ownership, right? And the value of the stock goes up when more buyers come than sellers. Why do people want to buy a specific stock? There's different reasons. It could be good news about the company. They can report their earnings, their financials, and they can make more money than they thought, or they can make a lot of money, and people like that. It could be a new partnership. It could be a new product coming out. It could be whatever makes people go buy this stock, right? So when there's more buyers than sellers, the price of the stock goes up. When there's more sellers than buyers, why do people want to sell a stock? Bad news, the exact opposite of what I just said. Bad news, they ended a partnership, they made less money, whatever. People want to dump the stock, they want to sell off the stock, so the price goes down. So with options, it's the contract that you're selling. It's not the stocks that you're selling, it's the contract. And the contract says you have the right to buy 100 shares, one contract, 100 shares of this stock at this price before this date. So you're flipping contracts. You got it? Stocks, you're flipping stocks. Options, you're flipping contracts. Now, what drives the value of the contracts up? The stock price, right? The stock price movement. So you see how it ties in with each other, right? So if good news comes out and the stock price goes up, then the value of the contract goes up, right? How quickly it goes up, that depends on, everything that's in that contract, right? Like the expiration date could be closer, which could make your contract more volatile. It could go up or down faster, So anyways, keep that in mind. All right, if you're following so far so good, just stick with me. We almost there. We almost at the end, right? All right, so we're going to use Apple stock as an example, right? So I just put some months here: January, February, March, June, September, November, December, right? January is at 125. Every day the market's open and goes up and down, up and down. February 1st, let's say it's at 134. So Tim has a contract, and his contract is the right to buy Apple stock, 100 of Apple stock for $140 before the expiration date, December 31st, 2021, for $4. But remember, there's a multiple of 100. So you might see the contract price is $4, but you're going to end up paying $400 because there's a multiple of 100 there, right? Again, the contract says, you will have the right to buy Apple stock for $140 before this date, 100 shares before this date. Why is that important, right? Let's say you buy this contract from Tim. All right, so you buy this contract from Tim for $400, right? So you're 400 out the hole, right? So as Apple price rises, as the stock price rises, especially as it goes further away from the strike price, the value of the contract goes up, right? So if Apple's at $134, right, and it starts getting close to the contract, the strike price, the value of the contract is going to go up. But imagine it's going to go past the strike price and it's going to keep running and keep running and keep running. So this is what's going to end up happening in December. December 31st, let's say Apple is at $300, right? So you want to buy 100 shares. That will cost you $30K, right? 100 shares of Apple at $300 is $30K, right? So instead of spending that $30K, you go, I got this contract that I got from this dude, Tim, right? So that contract says I have the right to buy 100 shares for $140. So instead of spending that $30K to get 100 shares of Apple, then what you could do is use that contract. You can exercise that contract that you spent for $400, right? Now you're buying Apple shares for $140 times 100. So you spent $14,000 on them. So let's say you spend your $14,000 on these shares, right? And now your average cost of, a stock is $140, but the market says it's worth $300. You got a $16,000 profit right there because of this contract. This contract gave you the right to make that much profit, right? So that's how it would play out. But what happens is as Apple's price moves closer or moves higher, the value of this goes up as well. It goes up higher and higher and higher and higher because you could flip this to somebody else, right? So how much do you think somebody is willing to pay to get this to avoid that? A lot. So that's the question that you have to ask yourself. How much is somebody willing to pay to be able to have the right to buy Apple shares at $140, right? To avoid paying full price for it. That's why the value of the contract's going to go up because somebody's going to want to save that money, right? So in the first scenario where you wait till the very last day, this is you just buy the contract with the intentions to execute it, the intentions to use it, and go ahead and buy those shares. But you don't have to. Like I said, you don't have to wait until December 31st to sell your contract or to execute your contract, because as the price of Apple moves up and up and up, this becomes more valuable. It becomes more valuable, more valuable, more valuable. So let's say you buy it today on February 1st. Next week, this might be worth $1,200, right? So that means you bought a contract for $4 and now it sells for $12, right? All right, so think about what you just did. You bought a contract for $400, right? And as the price of Apple went up, then the value of your contract went up, right? So you might not even have, let's say that the enough money to buy 100 shares of Apple. You don't have $14,000 to buy those shares, or you don't have $30,000 to buy those shares if it's up to $300 per share, right? But you have the right to do so. You don't have to, but you have the right to do so because you own this contract, right? So the price of the stock going up and up and up and up is going to drive the value of that contract. Now that your contract is more valuable, you can flip it to somebody else the same way Tim flipped it to you, right? So that's what you're doing. So I want you to understand this. If you don't know when a stock price will move, or when it's likely to move, or how far it's likely to move, you don't need to be trading options, right? Now, on the risk side of things, you could lose that entire $400. You bought that contract can expire worthless, right? So if you bought a contract for $400 and Apple starts moving the opposite way, that could go all the way down and be worthless. It could be worth $0 because nobody's willing to spend. Why would somebody be willing to spend $140 for 100 shares of Apple if the current price of Apple is $100 a share? Who's going to overpay for something that they could just go to the market and get, right? So you can lose the entire value of the contract. So if you put up 400, you could lose 400, right? That makes sense, right? Now, if you were to invest $400 in Apple stocks, then you're not going to lose your entire investment unless Apple goes bankrupt, which is very, 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 very unlikely, right? So that's why trading options is risky. You can make a lot more money, but that contract can expire worthless, and you could lose the whole thing. So let me put that on the whiteboard. So you bought that contract for Tim, right, for the right to buy 100 shares of Apple at 140 because Apple's currently at 134, right? Now, let's say Apple starts moving backwards. This scenario doesn't play out where Apple goes to 300. Apple starts moving backwards. So it starts going down in price, right? So this is what ends up happening. You own a contract that says you could buy shares of Apple for $140, but the market is selling shares of Apple for, let's say, $100. Then why would anybody go buy your contract from you, right? Why would anybody pay more than what they need to for these shares? The answer is they wouldn't. Therefore, your contract can expire worthless, or it could go all the way down to zero. So how much you spend on your contract is the max amount of money you can lose. So you spend $400 on your contract, you can lose this entire $400 because this could be worthless if that. So options, you could make big money, or you could take small money and grow it quickly, right? So if you ever seen somebody say, I spent $7,900 and it became $3,000, right? And they say they spent $79 on, I don't know, let's say Apple, and an Apple share costs $130. I'll see people in my comments arguing, saying, how did you buy Apple for $79 if a share of Apple right now is $134, right? It's because they bought the contract, not the actual stock. The contracts could be a lot cheaper than the entire stock is, right? The rights to buy 100 shares could be cheaper than one share itself. This is how you'll see people with crazy gains, and they say, I spent $34 and I made $800. It's because they bought a contract and the value of that contract moved like crazy. So when you guys see people who say, I spent $3,000 and my return is 40 grand, it's because they were trading options, and that option was very, very, very volatile, and they risk losing the entire thing, right? So like I said with stocks, you can't lose your entire investment with a stock unless that company goes under. If that company goes bankrupt, then you can. But if not, it'll just take a dip and you just wait for it to come back up, right? But with an option, the closer you get to the expiration date, the more worthless it becomes. Every single day, every single day that gets closer to the expiration date, the more worthless it becomes, right? So the value of the contract has to move even that much further to offset getting closer to the expiration date, right? So I just want to break that down for you guys really quick, man.